Good morning, everyone. This is Lou Weiss from Manufacturing Talk Radio podcast and video. Today, Tim Grady, my co-host, he's under the weather, so I'm doing a solo show with Tim Fiore, the committee chair for the Institute of Supply Management, and we are going to be reporting on the Manufacturing Report on Business. The number came out about an hour or two ago. Welcome aboard, Tim.
Yeah, thanks for having me, Lou.
Well, today is going to be a different kind of report, I gather. So why don't we get to it?
Okay, so for your watchers and listeners, we came in at 46.3, the weakest number in the last 3 years, I guess, since the pandemic. Since, well, maybe even since we started decline in 2019. So I know it's in the report, but
I did see a number 2020.
2020. Okay.
Yeah.
So, I think the headline, I'm going to give you the headline first. And there's really two. And it leads into the summary of the report. So the first one is, for the first time in many, many, many months, we have a near equal amount of companies commenting about reducing their headcount as those that are hiring. That's the biggest, first time we've seen that since this whole thing started. We've been running pretty much a 2-to-1, which means for every 3 companies that are giving me comments, 2 of them are hiring and 1 isn't. We're now close to 1-to-1, so call it 1-to-1. That's a clear change that the manufacturing community is now realigning themselves to allow the quits to happen, attrit down to a lower level, put hiring freezes in place. The 3 elements I look for are those two, attriting down to a lower level, freezing hiring, and then layoffs. But the layoff number has been pretty consistent. It's about a third of the total in that bucket. But it seems, my notional comment from going through the comments in the month of March is that it seems to be getting more urgent. So the second thing is that the manufacturing inventory number dropped to 47.5. That was my biggest surprise of the month. It's like, wow, that's a huge drop. You would, when you expand inventory, according to the PMI, that means you're expanding, getting ready for the future. When you're contracting inventory, there's only a couple of reasons for that. The first one that we've been living with for a long time is that they couldn't get enough product. Well, that clearly has changed with the suppliers delivering faster than they have in a long time, and they've been doing that now for a long time. So what's happening is the panelist companies are paying much more attention, managing how much of that inventory they're actually taking. We've talked several times now about the total supply chain inventory, which includes the amount of open orders that are out there from over ordering. That has pretty much been burned off now. The backlog, we've been working backlog, working overdue. It's been 7 months. I got to say, most of the over ordering is done. The second thing is customer inventory. How much inventory of mine does my customer have? And I like to stay in the too low area. I like to stay in the way too low area. And right now we're sitting in the low end of just right. It's getting awfully close to 50, which kind of says that my customers aren't going to allow me to ship what I want to ship. They're going to stop me from doing that, which is not a good thing for the future. The third element here is the manufacturing inventory. How much of my suppliers' goods am I holding of theirs? And usually a high number means I'm getting ready for the future, or it means I'm having to take stuff that I don't want to take. In this case, it's actually dropping. So that to me is a function of the really effective way that supply managers have managed that total supply chain inventory. They're not having to take the extra inventory because we've been able to step ourselves down in terms of output over the last 9 months to meet our current needs, which I think is a good thing because, whatever comes in the future, interest rate rises, you don't want to have a liquidity issue. And, we've had so many of these that were liquidity issues. This one has not been a liquidity issue. The bank issue that popped up about 2-3 weeks ago had the potential of being a liquidity issue. We'll see where all that works out. Banking liquidity is a bit different than manufacturing liquidity. But I think, we've been able to manage the total supply chain inventory so well that we burned off all the over ordering. Our customers are now at the low end of just right. They're not at the high end of just right, or they're not at the low end of too high, which, okay, that's good. And we're not taking a bunch of inventory on the manufacturing floor that we don't want. So all that says is that when we ended last year, we did our forecast, and we said that the first half would be lumpy. The second half would be a recovery period, and it'd be a pretty strong recovery based on the amount of hiring that we expected to do. Well, I think the soft landing, the slow slowdown, I don't know if I mentioned this, we've only had a 3 or 4 point decline since October. That's a really slow slowdown. And manufacturing is pretty cyclic, and we're not really cycling. We're moving 1.5 points. And even before then, we stepped down slowly. So, I think now the panelist companies are getting ready for a longer, slow period, which says that, July, August probably is not going to be strong months. They usually are not strong months anyway, from a manufacturing standpoint. There's a seasonal factor that comes into play there. But I think based on what I'm seeing now, and, thinking that we were going to hang around 48 to 52, we're now well below 40, 48, that this thing is going to extend out now into Q3, and we probably won't see a recovery until Q4. That's kind of the whole thing in a nutshell. And the last thing is, I do follow the percent of industries that are 45 or less. So we peaked out at 32%, I think, in December. In January, we dropped down to 25. In February, we dropped down to 10. We went back to 25 in March. So, and the biggest reason for that is food and beverage went in, and that's almost 10%. So that was a big, and it didn't go in heavy, it went in. Okay, we'll see what happens in March. But, the point here is that for me, 45 is a real break number. You get below 45, you got to really be concerned. 43 is a real serious number. The 45 is a real break number, and we're at 46.3. We're only 1.3 points off of 45.
How much of what is going on has to do with inflation and interest rates, as the Fed Reserve has been playing with?
Well, that's a good question. It's impacting investment. I don't think it's impacted profitability yet. I'm anxious for the earnings season to start. We're now in that month. I'm curious to see how companies have gotten through Q1 at high prices. We started the year, we were still fairly confident that we were able to push through higher input costs. One of the indicators of the Fed doing its job is layoffs, and then price reductions, cost reductions, which means you're not going to be able to push price increases through. And I'm getting some comments from the panelists that they're having a little bit more difficulty, but it's not to the point where I can say it's clear. But I think the earnings calls are going to be a really big eye opener on that. What are they really forecasting? We were the manufacturing community was very positive about 2023 when they closed 2022 in January, even though we had already gone through 8 months of increasing interest rates. We'll see now what the first quarter has done to their confidence that they're going to be able to maintain a decent profit level. Earnings per share will be where they targeted, or there's a change underway. But almost a 1-to-1 hire to fire ratio. We haven't seen that since the pandemic began. Manufacturing inventory down so low. All 10 sub-indexes in negative territory. All 10, and not 49.5. So I got to say, I'm expecting to hunker down here for a much lumpier, rough period than I thought a couple months ago.
But we don't hear a whole lot about the R word, recession.
No.
It's like disappeared off the horizon.
Well, yeah.
Sort of.
Yeah. I don't bother counting the comments that comment about that, because they're notional. We all have them. We all, with all the media firing at when's it starting? Did it already start? Are we already in it? I mean, you talk yourself into it. So I don't bother even counting the comments, but I get a lot of headline comments about well, federal interest rates is going to slow things down. So you know that that's what's being talked about on the factory floor and in the management team meetings, that everybody's waiting for this. And
Right.
I think so. You don't want to get hung out there with a lot of labor. So the best way to get rid of labor is to kind of let everybody know that, hey, we may have a rough period starting here, and let it all attrit down. Let it attrit down. This way you're not paying huge severance. And then the other thing is make sure you're not taking material that you can't use, because nobody wants to get stuck with stuff for what generally might be 1 to 3 months. They don't want to be sitting on it for 6, because that cash flow number will become really important if we had hit a more serious downturn. I think there's no doubt we're in a downturn, but it has not been dramatic. And we talked about this the last couple of months. Is there's 2 schools of thought: take a slow landing, or take it all paying at once. Well, the slow landing isn't getting to that inflation number. That's one of the 2 Fed prime objectives. It's not getting there. And with our pricing number at 49 and some change, I would have to say it's not going to get there. So what are they going to do about that? They need to get down to 2, and maybe they'll come up to 2.5% at some point. But you saw the PCE, you saw the CPI, you saw the PPI. I think the PCE came in at 4.6. That's twice as high as they want it to be. So what are they going to do?
One interesting index is the machine tool order index, which has been pretty strong, considering that everything else is sort of falling slowly to the wayside. Machine tool index numbers generally are predicting what's coming down the road 6 to 9 months from now, which brings it to the 3rd and 4th quarter, which supports what you said earlier. But so there are certain segments, and I don't know where machine tool order companies fit in your report, unless it's under miscellaneous manufacturing.
I think it's in machinery. I mean, machinery is our biggest capital intensive business. And
that's strong.
Yeah, and we're 51, up from a 40s, 49, and it's actually the best number we've had since October, but it's been hanging around 48 and some change and 51. Right. It hasn't really been. Back in October, it's 55.
Right.
So, but look at the new order level. We've been below 50 since October.
Yeah.
And it's generally that stuff is long lead time too,
Yes, it is.
Not a lot of it's built to stock, but some of it is. White goods is, farm equipment is built to stock, yellow goods.
So what are some of your panelists saying? I saw some interesting comments. So why don't you kind of run down that?
Yeah. So the headline sentiment, which is how we feel about the future, is pretty low. It's less than 2 to 1. So for every 3 companies, 1 is not so positive, 2 are, but we've been hanging there for a while. Actually, January was worse. It was almost 1 to 1. But I've also tracked the softening comments, and we peaked in the softening comments at 31% in December. We're still sitting at 25%. Orders are soft, which means that order books are not refilling, which means backlog is declining. General comments around labor, still there's comments around having some difficulty in finding labor, but I think it's really like a rifle shot. Like I said, our hire to fire ratio is almost 1 to 1. The quits number is the lowest. The last 2 months, the quit percent number is the lowest that we've had since I've been tracking it. And I've been tracking it since August of 21. So it seems like the quit side is diminishing. And, you eventually, we talked about this before, you eventually talk yourself into not quitting for a $1 raise, because the last one in's the first one out.
It's kind of interesting. All Metals and Forge Group, our manufacturing sector for our company, we're having a hard time hiring people. But what's even worse than that is we have a hard time having people show for their interview. It's the highest percentage is no-shows. It's amazing. I
They
don't get it.
come.
Don't get it. I just don't get it. I've never seen it to the degree that it has become.
Well, I think we've lost a lot of discipline. I think that, I'm going to make a generalized statement here that, especially the newer entrants, that they don't fully appreciate the value of a good job.
Mm-hmm.
And they've been able to kind of just stay home when they feel like it and walk out when they feel like. I think all that needs to change. It's not a healthy environment, but it's not going to happen overnight. It's going to take some time. And that's also a supporting comment around a more drastic, quote, recession. Is that if we don't get to one where we have significant layoffs, people aren't going to change their attitudes. You can see what's happening too now around returning to work. More and more companies are saying, I want you in at least 3 days out of the week. I mean, think about it. A year and a half ago, it's like, well, who's going to make that decision? Well, now we're saying it more. But if we hit a recession period, we'll be able to insist on it. And I think the future is really, at least for office workers, is 3 days in, maybe 2 days home, or 4 days in, 1 day home. I don't think we're all going to have to show up back in the office again. But all staying working from home, that's going to be a small percent, because people are getting more and more concerned here about what it's really meaning to their company culture. And we're 3 years into this now, right?
Absolutely.
Yeah, I mean, when we talked about this 3 years ago, it was like, wow, what's going to happen 3 years from? We're in it now.
We're there. And I think, frankly, that COVID is what's caused this malaise of, well, I think I'm going to stay. Nah, I'm not going to go for that job. I'm not going to go for that interview. They don't even call.
Yeah.
They don't even call. I can't believe it. And
Well,
they're all youngsters meaning mid to late 30s. They don't call. They don't show. Amazing.
they should know better. They should know better. Well, we've had this has been the most unusual upset ever, and we're still being impacted by it, especially when it comes to people's attitudes.
Well, I think that this is the new normal, and I think it's going to last us for several years. It's already 3 years.
Yeah, it is. Yeah, but it's only been about 9 months since we can kind of walk around and not feel like we had to have a mask on all the time.
Right.
Isn't it about 9 months, maybe?
About that.
Yeah.
My wife still walks around with a mask.
Well, that's her choice.
I don't know who she. Are you my wife? Who are you?
I see him down here in Florida too, but you remember the day when you had to. Jeez, the gloves.
Yeah, I never did the gloves.
Wasn't that long ago?
I wash my hands 92 times a day, but no gloves.
Yeah.
So what do you see for next month? Another drop? 45?
Well, I'm kind of reluctant. I was saying 48.52. We're clearly off of that number. I think we're in a period here. I don't see why demand would come back automatically.
Yeah.
So you can almost argue that, geez, I mean, we've been working off of all this overdue, and with reduced rates, and at this point now the customers have enough of it. Okay. So I guess I would say more of the same. I'm hoping we stay above 45. This could have been just a slow decline to a 43.
Yeah, maybe bottom out at 45 and a little trough like.
I was hoping last month was the sign of a little bit of a recovery, but clearly not. And we seem to be doing these 2-month cycles. It's we seem to be coming down, recover a little bit, then come down again. It seems to be in that kind of wavy kind of thing.
Well, we're going to keep our fingers crossed. Any parting words besides gloom and doom?
Well, I think you're going to see more layoffs. Well, I'll tell you what. You're going to see more layoffs. I think we don't have people fully appreciating their job yet. I think we're not going to see a liquidity problem in the manufacturing sector because we worked our way through. And I think we've worked off all of that backlog to the point now where we need to address headcount. Like I said, the biggest thing now is earnings season, see what the earnings look like. And that's April. So I'm really anxious to see what the next month is going to read, because there's going to be a lot of elements in there, and I can't really predict it, but I don't see it recovering.
So we're going to leave it at that. Tim, thank you very much for joining us, and everybody who's listening to us. Tune in next month to hear Tim with his prognostications. And in 2 days, we're going to have Anthony Nieves, who's going to give us the report on services, which lately has been pretty good. So we're going to have to wait another couple of days. Tim, thank you for joining us. Let's get your numbers up, buddy.
Okay. Thanks, Lou. Thanks for having me.
All righty. You be well. Everyone, thank you very much, and we'll see you next time on Manufacturing Talk Radio Podcast. Thanks much.